Hello and welcome everyone. Thank you for joining us today. We're going to be discussing a very exciting topic. We'll be covering the 2025 M&A market outlook and the trends we expect to see this year. My name is Kayla Sullivan, and I oversee the transaction support team at our headquarters at the Tampa, Florida office. And I'm joined today by our two hosts, Dara and Derek Abdul. They both are going to be bringing very unique and interesting perspectives to today's discussion. We have Dara, who has venture capital financial buyer experience, and Derek, who has more of a corporate strategic M&A background. They both have decades of experience as well on the sell side and lower M&A market. So welcome, both of you. Welcome, Derek. Welcome, Dara.
Thanks. Excited to be here. I think this year is going to be extremely fun and excited for the lower middle market, kind of that sub $500 million transaction value. This year, we're really excited about it.
Yep.
Yeah, thank you as well. I'm pumped up for this year as well. I think we'll have an incredible 2025. I do think it's important, though, that we talk a bit about, as a backdrop, what 24 looked like before we dive into 25. 24, I think the word that comes to mind is uncertainty. We had an election with candidates that had entirely polar opposite views on how to operate a country and an economy. And folks, I think, were a bit hesitant to act. And I think because of that, we had a year that was characterized by a lot of uncertainty, a lot of folks who were sort of sitting on the sidelines. So I think that leads right logically into 25, which should be an incredibly explosive year for M&A.
So before I go into the topics that we will be discussing today, just a quick housekeeping item. We will be accepting questions throughout the webinar today. So please, we encourage you to submit those in the Q&A chat, and we will be going through those at the end of the session during our Q&A session. So the topics that we're going to be diving into today are going to be political climate, so the impact of new administration, what does that mean for the 2025 M&A landscape and how does that look, the impact of interest rates, as well as the current Fed's moves, what does that mean for the 2025 M&A market, corporate balance sheet strength, so how does that look for 2025 M&A corporate initiatives, private equities, capital deployment. So PE firms are being, pushed to deploy their dry powder reserves. And what does that mean? We're going to dive into that. And then M&A FOMO, or the fear of missing out. So how is that FOMO going to be shaping buyer and seller behavior in 2025? And then lastly, all of those items, how is that going? That's going to be driving the M&A momentum. So what does that mean for the broader macroeconomic outlook? So I think we can just dive into the first topic, which will be the political climate. So as the new administration takes over, what initial changes do you foresee, and how might these impact businesses, M&A activity, and pricing?
Sure, I'll dive in. I just before we start, I want to make sure that when we talk about the M&A outlook for next year, we are specifically talking about that middle market, lower middle market. So that's, like I said before, the sub 500 million, just to use a barometer of those transactions. And I think especially on this topic with the political climate, there's a lot of talk about M&A and regulatory environments and all that. That tends to impact the mega deals, the multi-billion-dollar deals a bit more than the market we're talking about. But I think from a political climate, I think Dara hit it on the head of just saying there was so much uncertainty at the end of last year. It actually almost didn't matter in general in terms of who got elected. It was just that somebody got elected and there was a smooth transition, which we anticipate. And so I will say that I think in general, the political climate right now is optimistic for the business environment and for the M&A environment. And so regardless of what happens, and it will take time, and I know you'll talk about this, Dara, as well, is that there is optimism out there. And there's optimism about what this means for the business climate, what this means for the regulatory environment, what this means for just in general the broader macroeconomic environment in the coming years. And so I think that sets the stage very well for the market that we're talking about.
Yeah, I think that's a great point. Just to sort of add to what Derek had said, I saw a stat recently that said second-term presidencies tend to see a 101% increase in M&A deal volume on average over the last 40 years. That was staggering to me. But I think what that means is that perception is more important than reality, right? So, we have a new president coming in. We've seen what his mandate is in the past, likely to probably take that and advance it further. But that perception that he's going to reduce regulation and reduce taxes and end wars on multiple continents, it's really the perception that matters more than whatever he actually does in the first 100 days in office. Because as a president, it's really hard to make a significant impact in the first several months of your administration. It takes time to get things through, even with a friendly Congress, right? So perception when it comes to markets always matters more than the actual reality.
Yeah, those are all, very great points. And so kind of leading into that, are there particular industries that are going to be impacted by this in 2025?
Well, I think, of course, some will be impacted more than others. Obviously, the discussion around tariffs and that will impact, supply chain manufacturers and those kind of industries. But again, I go back to the market that we're talking about is not as immediately and dramatically impacted by some of those things as the much bigger companies are. And so I don't anticipate anything in the segments, kind of the broader industry segments that we serve that represents that lower middle market are going to be too impacted on that. I don't know if you have a different feeling on that.
I'll take a slightly different tack, though I don't disagree with Derek. Yeah, I think any industry that's overly impacted by regulation, right? So you think about healthcare, the FDA, loosening the FDA, speeding drugs to market, anything that interacts with the FDA, for example, compliance, regulation, right? So you think of healthcare, you think of in some ways manufacturing based upon some demographic trends in our trading partners. China has a demographic hole. Their manufacturing base has been really decreased dramatically over the course of the last several years. They're actually our third largest trade partner now. And the notion that more stuff will be manufactured here over the next probably 5 and 10 years. So I do think there's going to be an impact specifically around folks that are impacted by compliance and regulation, and also that manufacturing orientation that I think Trump brings to the table here. Think about the automotive industry, anything that touches that. I think we'll see a lot more car manufacturing coming here. At least that's the hope, and that perception again is probably more important than what the reality is. So I think that anything that touches compliance, regulation, and then we have sort of taxation, what can happen there. So there could be huge impacts to a number of industries, any number of industries. But again, it really is perception more than reality.
Yeah, no, that is a fair point. As I think about it, I think from a supplier standpoint, I've certainly talked with a number of companies that even before this, in the last several years, just in general, have said they're trying to diversify their supplier base, outside of China, just because of a broader concern, let alone the focus on tariffs and all that right now. So that is probably true that anybody that's touching that, they all need to look at, from just a general business standpoint, their supplier base and, moving that, not being solely reliant on China. Are there other, Asian and other countries that can supply that as well as domestically here?
Right.
And I think, all those points kind of raise a burning question that we've been getting from our clients, right? So or potential sellers, should companies, sell in 2025, or should they wait for these policy changes to, come in place?
We get that question all the time. It doesn't really matter whether you have a new administration coming in. It's the time to sell is when it's the time to sell. It shouldn't be waiting for your EBITDA to be at its peak. It shouldn't be after you sign that perfect contract. If you wait, something else will happen, whether it's in the external market or in your business, that gets in the way of you having that exit event. So my view is you should always be market ready. Build your business such that it is ready to go to market within a few months. Handle your financials in a way that allows you to package it in a way that can go to market quickly. Be ready to take advantage of opportunities because they come up quickly and sometimes they dissipate. So the reality is you shouldn't wait, because if you keep waiting, it's like when, should I buy that TV now? It's at only $1,000. It might be $900 in a month. Well, what if it goes to $1,050? Now you've not had that TV for that month that you wanted, and the price went up or stayed the same. So, we have demographics in this country where 40% of small businesses are owned by baby boomers. The time to sell is when you need to sell, right? It's not just about capitalizing on a top market. So I think waiting is always a mistake. That's my view on it.
Yeah, and I think going back to kind of tying it back to the political environment, I think trying to time the sale of your company with what is or is not going to happen from a policy or a regulatory environment is a crapshoot. I think it's really tough to do that. So I think Dar made a great point, is when it's right for you, that's when it's the right time to sell.
So maybe Derek's point's even better, frankly, because it just includes something into my brain here, is that, Trump's got a friendly Congress right now. What happens in 2 years, right? So we often see, and this has nothing to do with which party is in power, when you have the executive branch and when you have both sides, right, you tend to see a reversion in the midterm elections. So it's very likely that they give ground. I don't know how much ground. So it's really that first 2 years that matters most. And if there is a retrenchment there, and the Democrats take control of either side, the House or the Senate, that could really gum things up. And now you've waited, and now you have factors that you probably have gridlock, right? And that's how it works typically. So waiting based upon something that you have no control over tends to be a mistake, whether it's political or something else.
Right. Which, goes into another hot topic that most people have been talking about this year, is, the impact of interest rates and the Fed's moves and the current environment with that. So with the varying predictions about potential interest rate cuts in 2025, what role does that place in federal monetary policy, and how is that going to shape the lower middle market M&A?
Sure, I'll start with that one. I think I just love hearing that. And you watch the news, you watch CNBC, and it gives now predictions on the market is saying, whatever percent on whatever day it is, there's going to be this many cuts next year, this many cuts next year, and it goes. They were doing the same thing in 24. There's going to be 7, there's going to be 5, there's going to be 3, and it's just like you can just pick whatever number you want. I think the point is on this over this year. My view is, look. They're not going to go to 10%. They're also not going to go to 2%. Okay, we're in that kind of 4.5, 5% area, and it's going to stay, pretty similar to that over the next year, in my view. Does that impact the lending environment and M&A? Of course it does. But does it have a dramatic impact on whether or not a deal gets done? For the most part, no. In my view and my experience, it doesn't. It may impact a little bit in terms of some of the value and the structure and those things, but I don't think it, dramatically cuts off or accelerates deal volume that much. Or certainly in the next year. That's my view on it.
So if you look at actually what happened last year, they started cutting in July, right? So the prior year, for 12 months, it had stayed steady. They started cutting in July. They cut 3 times. For a total of 1%. And signaled in December, I think December 18th was the last policy meeting, they cut 0.25% and signaled basically 2 more 0.25% cuts next year. And that's it, and perhaps 2 more in 26. So I think we're gonna be close to where we're gonna live for the next year or so. And let's take a step back also. Let's talk about how rates impact M&A deals, especially lower middle market M&A deals. So buyers tend to use debt to help finance their deals. More so in the lower middle market, you see a little less reliance on debt than upmarket. So upmarket, to finance these mega deals, you really require a significant slug of senior debt typically, right? So they are very much reliant on these interest rates. Lower middle market, they do use debt because it's efficient, right? The cost of equity capital for most professional buyers is in the 20% plus range. The cost of their debt even now is maybe 8 or 9% if they're looking at senior. If they're looking at private credit, it might be in the low teens, but it's significantly less than the cost of their equity, right? So they want to use as much debt as they possibly can to reduce their overall cost of capital. So it does stimulate deal activity. There's no doubt about it. Down market, though, the phenomena is a little different because buyers have the capacity, especially larger buyers and private equity funds, to buy businesses with cash in the balance sheet, with money in their fund, and then overlay debt later, right? When interest rates are down, they can actually refinance later on and still get the deal done. Whereas if you're looking at a $5 billion deal, you're not using cash to buy. It's completely inefficient to use cash to buy that business. So, I think it's important to understand kind of why it's important. But I also think rates coming down to where they are today and going down even more a little bit next year, or this year actually now, should signal, great activity here in the M&A world.
Yeah, which kind of goes into corporate balance sheet strength with Derek. You might want to kick this one off, but, is it better to sell to a corporate strategic buyer than a PE group? And how does a corporate acquirer strong balance sheet influence M&A outcomes?
Sure. So, well, I'll take the one part of the question first is it better to sell to a corporate buyer or a PE buyer? I'll give that fantastic answer of it depends. It depends on the situation. It depends on the buyer because, we can get into that a little bit, but, a PE buyer, a private equity buyer doesn't necessarily mean just a financial buyer. It may be their portfolio company. So is that a PE buyer or is that a corporate buyer? Because it's a corporation owned by a PE company. So you get into that. So from who's the right buyer, that's a little bit of a different question. I think to the point about the strength of the balance sheet for corporate buyers in particular, and what I've noticed and what I from my prior experience being on the corporate side is that when you do have a strong balance sheet on a corporation side, you are looking for growth. You're always looking for growth, but you tend to look more aggressively when you have a strong balance sheet because you can spend more on internal initiatives, on internal product development or service development, and then on external. It's oftentimes one of the first times when a corporation will start thinking about inorganic growth or M&A when they have a strong balance sheet. They have a lot of cash and it's like, okay, we want to go into this area. We've been talking about this buy versus build strategy. Why don't we just go buy? So there is, I think, going to see a lot of that with these strong balance sheets, more kind of corporate buyers out there actively seeking strategic deals, whether that's for new products or services, getting tech enabled and things of that nature. So I think that just the overall strength of a corporate's balance sheet lends itself to more M&A.
And, why do we think they are so strong in 2025?
I think they were getting stronger in 2024 and continue to build up those the cash on the balance sheet because whether it was delaying initiatives around uncertainty or not being able to find quality targets, which was a challenge for both corporate and PE buyers, it just kind of fed itself over the last year. In my experience.
I agree. I mean, corporations create cash, right? Their income statement, at the bottom of the income statement, you have net income, and then you either retain cash for initiatives or you distribute it out, right? And growth companies should be using that in a productive way, greenfielding new departments and ideas and services and products, or acquiring to grow. And growth companies need to grow. And in uncertain times, it's actually easier to acquire than it is to greenfield a new idea, a new location, right? Especially in these parochial businesses that have a lot of folks that want to kind of buy locally. So I think there were a lot of folks chasing few deals last year, both in the corporate side and also in the private equity side. Really only the highest quality assets went to market last year. We had a lot of folks that were a little uncertain and stayed off market. So the high quality assets businesses really were competitive with buyers. Most of them swung and missed. I talked to a lot of buyers last year. I was at a conference in November and I had 40 meetings in a day and a half, and I needed a cocktail after that one, I can assure you. It's a lot of meetings, but I think one out of the 40 said that they had a great year in terms of acquiring businesses last year. Most were looking for 3 to 4 platform investments. These are professional buyers. They did 0 or 1 because it was so competitive, because the quality businesses it was a feeding frenzy. Because a lot of them sat, say, on the sidelines and didn't go to market. So there's so much dry powder ready to attack these businesses this year. If you've been waiting because of the uncertainty we talked about, it's time to go to market, and you will see whether you are the best of breed or just a quality business. We expect to see incredible activity in the lower middle market, not just from corporates who have incredible stores of cash, but also private equity who just couldn't get deals done. And if you know how private equity works, if they don't put money to work, they don't raise that next fund, right? So they have to execute on their mandate. So we should have an incredible year because the amount of cash that's on corporate balance sheets and the amount of dry powder in the coffers of the funds out there.
Which, kind of goes into what, we mentioned earlier with the private equity. So what is dry powder?
Sure.
Yep, let's go into that. And why is it important?
Right, so funds, you go out and raise a $500 million fund, right? You get commitments from endowments at universities and various insurance companies and high net worth individuals and all kinds, institutional capital and also capital from really rich folk. You pool it together in a big fund. You don't take all the money, you take it as you need it, and you have a mandate over the course of typically 10 years. You deploy it over the course of the first 5 or 6, and you start harvesting. The last piece you're mostly harvesting, adding on with smaller investments. But if you don't put that money to work, because by year 4 or 5, you're starting to raise the next fund. That's how you make your money. These guys make money, their salaries and their expenses are paid as a percentage of the overall fund size. The limited partners who commit the capital, part of that money is directed to pay the operations, which is the salaries of all the private equity folk, all the way down to the receptionist, right? So if you don't have the ability to deploy fund 1, you're not going to raise fund 2. And that's a real problem. So they have to put money to work. But there has to be a willing seller on the other side of the transaction to commit that capital, to go buy companies. So there's a lot of folks who tried to buy companies last year who could not buy companies because there were so few deals getting done. Now, we had a record year again. We did 215 deals last year, 20% more than the prior year. So we continue to experience going up and to the right, but that's not what happened in the overall market. So there's a lot of funds out there who have money that they have to deploy. That's what we call dry powder.
And so with all this dry powder, does this mean that there will be more small acquisitions as PE firms push for more deals, and will they pay more?
Well, I think it goes back to the quality issue. The PE firms or corporate buyers are looking for quality companies to buy. And so I do think that there's been a lot of companies that were on the sidelines because of the uncertainty. So I think we're going to see, I don't know if it's a return to quality is the right phrase, but I do think we're going to see more quality companies out there this year. I will say that, it depends on the industry, but in general, I would say we've leveled the playing field a bit in terms of it being a seller's market or buyer's market. I think it's kind of both right now. And I do think that will companies pay more? I think what you'll see is an adjustment in structure this year. I think you'll see a little bit of a tend towards more cash in order to get those quality companies from private equity or from corporate buyers. I think on the private equity side, look, I think Dara captured it, that there's certainly money out there that wants to buy those platform companies, but at conferences that I was at over the last year, they are all, as well as looking for platform companies, trying to find quality add-on businesses, which is right in our wheelhouse. And I think that there's going to be a very active environment for both segments. I think you're going to see a lot of competition on the platform side, and I think you're going to see a lot of activity on the add-on side, just from both, especially from PE groups, looking to deploy that dry powder within their portfolio companies that they already have, and saying, okay, yeah, we need to continue to deploy capital, but we have to find growth opportunities for our portfolio companies. So that's where my head goes.
I totally agree. I think you'll see both. I think you'll see a lot of deal activity this year, both at the larger company level and the smaller company level, and it'll be corporate, it'll be private equity. I also think we're going to see a lot of deals getting done that are sort of enabling or making certain non-tech companies a bit smarter, right? So I think you'll see some of the larger companies carve out non-core units to focus a bit on what they do best, and then lob in some enabling technologies, smaller businesses. We had a semantic AI company that I'll probably touch on later that got the attention of a lot of folks, very small business, but got a lot of attention from folks because it really does sort of unlock power in a larger institution. So I think we'll see across the board incredible activity in the M&A world.
Yeah, and just going back on my point, look, I think the reality is do I think valuations are going to be off the charts this year from a seller standpoint? Candidly, no, I don't. But I also don't think that they are going to be excessively cheap on that side. So I think it will be a pretty fair and strong valuation market from a seller standpoint. So it's kind of like, I just think it will be solid. I think it's going to be a strong, solid seller's market this year. I think it's level set a bit. I don't know if you have a different view on it, but that's I think, of course, like I said, industries will vary, but I do think the environment overall is a strong seller's market because there is so much capital out there from corporate and PE buyers that need and wants to be deployed on quality companies, and they will be willing to pay, quote unquote, a little more than maybe they have in the past.
Yeah, I think it'll be a strong market for valuation, no doubt. I don't think it's going to be what we saw, in 2021. That's unlikely. That's not likely to recur maybe ever. But I do think it's going to be a very strong market for valuation because you just think of how markets work. Markets are really parties, right? And you have a buyer and a seller, and it's about establishing a price that they're willing to accept and pay. And when you have a lot of capital that you really want to deploy, you're less price sensitive. And so I think we will see creeping up some valuations, and some of the higher quality, assets will command premiums as they always do. So I think you will see outsized multiples on certain targets in specific industries. But I do think overall it'll be a very healthy valuation market.
Yeah, and I think the way that I view it too sometimes is that there's the transaction value, the overall value, but if that transaction value is made up of more cash,
Right.
is that quote unquote more valuable than one that's earn out based?
Most of our clients would say yes. Yes, that's a good point.
Or it depends, right?
Right.
Like we said,
Yeah.
yeah.
Right, yes. Of course.
True.
Exactly. Yeah. So I feel like a common question we also get from sellers in lower middle market is, are these big PE firms and big corporate buyers really interested in these smaller deals?
Well, I think I touched on it earlier. I think they certainly are from an add-on standpoint. So I think, look, if you're a big corporate buyer, when I was on the corporate side, if it was a $1 million EBITDA company and we didn't have something in that space, then probably not. But if that was an area that a corporate buyer is already in, that can roll it or tuck it under or add on, absolutely. And same thing with the private equity groups. If they're out there looking to say, hey, we want to be in this new segment, are they going to look at smaller deals? Probably not as much, but if it's like, okay, we have a portfolio company that's in that space, absolutely we're looking for add-ons. And that's a refrain that I've heard from corporate buyers certainly over the last year, private equity groups over the last year that says, look, this is what we're looking for in platform. We found it tough, but by the way, here's our portfolio companies. If you have anything on the add-on space here, let us know. Because even though our website and our mandate is, we only look at companies between 2 or 3 million and above of EBITDA, if you have an add-on, let me know, because they're dying to find quality add-ons.
Yeah, I think that's a good point. I also think that a big deal is a bet your business kind of deal, right? So we still have some uncertainty here. We don't know what's going to happen over the next sort of 6 months. I think folks are very positive about the economy and the M&A market, but there's still some uncertainty, and I think you will see buyers attacking smaller deals, largely because if you swing and miss, if you make a mistake on the integration, maybe it's the wrong target, it's not a bet your business sort of deal, versus buying something that's a quarter your size could not only crater the acquisition target, but also crater the acquiring company, right? So when things are a little uncertain, you tend to see big buyers doing a lot of smaller deals. So I think we're going to see a lot of it. I think we're going to see the full spectrum of deals this year, whereas last year was a boom or bust. I think really big deals, there weren't a lot of them. And I think a lot of it was because of really getting tied up at the Federal Trade Commission and DOJ and a lot of that activity. I think we'll see a reversion there a bit. I think the loosening there on both of those sides, on the DOJ side and the FTC side, will create more upmarket activity, and a rising tide lifts all boats. So I think there's a lot of tailwinds here.
Which, leads into next for, sellers and buyers with, M&A FOMO, or the fear of missing out, and, how that's going to shape their behavior in 2025. So with all of the, M&A talk going into this year, do we expect buyers to be spooked by potential increased valuations and just wait for all the hype around M&A to die down?
I don't think so. I think I said it before. I think I think it's level set a bit. I think that buyers will be willing to pay more for quality companies. And I think sellers will see in my view, a positive shift in some structure in terms of how some deals are structured and that. So I don't think they're going to be spooked that way. I think both sides have a bit of that FOMO, that fear of missing out, of just saying, well, wait, I need to do these acquisitions. I need to deploy this capital. I need to grow these businesses. And then on the sell side, it's like, well, look, this is a good environment. There's a lot of good quality buyers out there. I can find the right one for me and for my company and for my employees in the long term that will help my company and my legacy continue to grow. So I think it's good on that sense. I think, the FOMO aspect of it is, look, the rhetoric out there, and we're having it today, is that, look, we do think the settling down of the uncertainty and the calming a bit of where we're heading from a macroeconomic and a business environment has been good. And I think it leads to, I think, a very productive business environment and M&A market in the next year. And that's a great time to sell if it's right for you. And I think the only time you get you have that fear of missing out, but then the only time you kind of say, oh, I should have sold then, or I should have bought then, or I should have waited for that, is in hindsight. So it's only going to be in the future when you look back and go, okay, yeah, I waited in 2024 and I should have done it in 2025 and I didn't. I don't care which side you're on. You're only going to know that in the future after the year's over. So again, it goes back to, I think, one of Dara's initial points is, you should always be ready to sell. Doesn't mean you have to, doesn't mean you should, but you should be ready. That's my view.
That's a lot of things in life, right? In hindsight. So
That's right.
Yeah.
That's right. Yeah, I mean, professional buyers are in the business of buying businesses. I mean, it sounds ridiculous to say that out loud, but the private equity person's job is to acquire companies with a pool of capital. So they're not going to wait for some event to happen in the future or not happen in the future. They're going to act as if, life is going to continue on as it had, because their job is to take this pool of capital, deploy it by buying businesses, right? That's their mandate. If they don't do that, they don't make any money, right? These guys tend to make a decent salary, but their real money comes at exit events. They get carried interest, which could change. The taxation of carry could change. Possibly, it's unlikely during this administration, but that's how they make their money. They've got to put money to work. Corporations, large corporations, have corp dev, corporate development. Derek was in it. They have departments. Their charge is to basically be a private equity fund, to source deals, to vet deals, and to do deals. That's their job, right? Because companies grow organically and they grow inorganically. And the way to really launch into new markets, probably most efficiently, if you choose and integrate correctly, is through acquisition, right? So on both sides, their job is to do deals. So they're not going to wait for some event to maybe happen or not happen. They're going to keep doing their job, or departments will get cut. Because if you don't do deals in corp dev, you slash the department, the budget gets cut, right? If you don't do deals in private equity, you have a mandate, right? If your money isn't deployed, you have extensions, and it could go as long as 12 years. But if you're not putting money to work, you're not raising that second fund, right? You're going to end up doing something else other than private equity, right? So that I don't see that as being a real threat.
Yeah, I think to follow on with that, I think that's on the buy side, which is very true. On the sell side, it goes to, you only have the FOMO, or the fear of missing out, is if you don't explore it. Again, it goes back to, just because you get your business ready for sale, just because you put it on the market, doesn't mean you have to sell. I mean, it's one of the things we tell our clients all the time, is we need to find you need to find the right buyer. And the right thing may be the right value, the right structure, the right cultural fit. And so I think it's going to be, and it is a great environment for sellers to explore those options. You don't have to take it. Even if it's
Right.
even if it's quote unquote a great deal. If it's a great deal from an external viewpoint, but it's not a great deal for you, then it's not a great deal. And so as long as you've explored those options and as long as you've done that, then I don't think there's any FOMO aspect of it. And so I think that's the main thing is I don't think we'll have a problem on the buy side because that's, as Dara said, that's the mandate. That's what they do for a living. I think sometimes on the sell side, it's like, should I wait? Should I not wait? When is the right time? When is not the right time? There's no harm in exploring it because it's worth taking a look.
Yeah, on the sell side, it's a great point. I totally glossed over that. So, and we work for sellers, so I should be focusing on sellers. So, if you're a seller and you have a business and say you do $1.5 million in EBITDA pretty consistently, and you think you're going to grow and you have a growth opportunity that's going to get you to $2.5 million. Well, a lot of things can change over the course of that couple year period that gets you from 1.5 to 2.5, right? Maybe you lose a customer, maybe a new threat comes in, a new competitor comes into your market. Maybe there's an opportunity for someone in a different market to attack yours, right? So you never know what's going to happen inside of your business. Just because you've done consistently a certain number doesn't mean that's locked in for the future. That's one thing. And then there's the market threats. You have no idea what's going to happen in the external market. Interest rates, things like that can change, and there's no way to mitigate that, right? And interest rates going sky high for whatever reason, that creates a cost of capital problem for buyers, and you do compress multiples. There's no getting around it, right? So inflation could be a problem, right? I mean, we've talked about this a little bit, but tariffs. If there were an across-the-board tariff, which I don't think will happen, I think that's more of a negotiating tactic from President Trump. But if there were, that's inflationary, and there's no other way to look at it, right? Because we know who pays the tariff. If Best Buy is importing TVs, they pay the tariff, and it isn't the manufacturer, it's Best Buy, and they pass that along to the consumer. So if there were across-the-board tariffs, it would be completely inflationary. If we deported, with mass deportation, that can be inflationary because there are jobs being performed by some folks that Americans may not take at the current rates. So the price of labor will go up. That's inflationary. So there's risk everywhere. The time to sell your business is when life intervenes. It's when you want to spend more time with your family. I did this in my last webinar, but as males in this country, we're locked in at 75 on average. That's as far as we go. Now, it doesn't mean that's as far as you're going to go, but if you're 68 years old, 70 years old, what's more important? An extra million or two? Or more time with your family? At the end, we don't talk about missing an opportunity in business. We just don't. We talk about missed opportunities with our loved ones. So, all these factors, waiting for this perfect, time to execute, you're going to miss it if you wait, because we know it takes you 18 months to get a deal done, 12 months if things go perfectly. The moment you decide, hey, I want to sell, you got to select a banker, you've got to get all your stuff prepped, get them to write a book, take you to market, and then close a deal. There's a lot of stuff that needs to happen. So you can't sell in the moment, you have to be ready to sell. So waiting, in my view, is a mistake.
So how can lower middle market sellers prepare themselves to take advantage of, the current M&A environment?
I think Dar just hit on it, is being prepared to sell. It's a long process, but it's not. It doesn't have to be dragged out. It's not like you're going to be perfectly prepared. That's the other thing too. Is don't worry about if your financials are not perfect. Okay, you don't have to have a complete set of audited books for the last 3 years in order to be ready to go to sell, especially in the market that we're talking about here, which is it's smaller businesses, so there's differences in it. There's not as tight accounting and those things. But just if you're organized, get your financials organized, get your information, in terms of how there's policies, procedures, and standards of your business organized. Basically, just if you were looking at your business from the outside, could somebody understand how it's run, what the numbers are, what the results are on that front? And then the biggest thing from a preparation standpoint, obviously you need to have that, but and I often use it as the hit by the bus preparation. Is like, if you're the owner or a small group of owners that are running the company, what happens if you get hit by a bus? Can the business run without you? Can you go on vacation for 2 weeks and can the business run? If it can't, think about that and start implementing things to make it that standpoint, because in the long run, you're not going to sell the business, even if you're in it for a transition period, and run that business like you have for the last 10, 20, 30 years. It's going to be somebody else running the business. And if everything is dependent upon you and your relationships, that needs to change in order to make it more attractive to buyers. So I think that succession planning and that next layer of management is one of the most important. Obviously, you need to have your financials in order, and then if there's key customer reliance that you can diversify and mitigate and kind of lower that's key. But really, it goes back to the kind of the management level beyond the owners, because most of our companies that we represent are founder, family owned, often founder led, and that needs to be able to be done by somebody other than just the founders and the owners.
Yeah, what a great answer. I don't know that you covered every point I was going to cover. Maybe I'll just get a little more detailed in terms of what he's talking about. The best businesses I've run into, whether it's in the process of selling them or just working in them or interacting with them, knowledge is institutionalized. It's seeping out of the walls. It's not living in the brains of key people, because key people come and go, right? And they don't have to be murdered or hit by a bus, but they may decide that it's time to peace out, and they're done. So the best businesses are the ones that have pushed down relationships, pushed down institutional knowledge, spread it across. That's mitigating. That's mitigating risk. If they have a single source supplier, they look for other supplier relationships. You're professionalizing your business. You're starting to put together some external perspectives, like an advisory board or even a board of directors. You're starting to think about bringing in even a part-time CFO if you've gotten to a certain point, professionalizing your business. That's how you can start to get yourself ready. And that's just a little more detail on Derek's answer, which was about as good as you can get.
Yeah, that's great. So, we've covered a lot of economic, drivers today, that, political climate, the interest rate, private equity's push to deploy capital, strength on the balance sheet. So all of this is kind of driving the big M&A momentum in 2025. So out of all these factors that we've discussed today, what do we think is the most important or has the biggest impact for the M&A market in 2025?
I guess I would probably say something like the kind of the pent-up demand. There's just a lot of, over the last year, what I saw, look, this time last year, there was a lot of hope that the M&A market was going to be stronger than it had been in the previous year. And in certain segments it was. But I think just the massive uncertainty over kind of interest rate cuts and the election in the last half of the year really just kind of put, everybody was like, can we just get through this? We just got to get through this because we're not sure what's going to happen. And I think that the fact that we got through it, and we have a new administration coming in, and again, it doesn't matter your political views, it's a decision that was made, so it removed the uncertainty. We kind of know where interest rates are going to be in general. Yes, if they spike and something happens, of course. But in general, we think they're going to be pretty stable. So I think that's the desire that goes, again, the dry powder, the strong balance sheet. So we have just a really active buyer's market that is looking for quality deals. And we had a lot of quality companies that were kind of either on the sidelines or not fully committed to doing a sale. I think those are both going to come together this year, and that's why I think it's really going to be a very robust environment for M&A.
This is probably not good TV, but I'm going to end up agreeing that is probably the biggest factor. We've covered a lot of ground here, and I'm going to give you a long-winded answer in a way of just agreeing with Derek. Interest rates changes, inflation issues, wars on multiple continents, all political uncertainty around the election, all these things did create a bit of a stall in the general market. Again, we didn't experience it at Benchmark, but I think we have some insulation where we operate and how we operate, and we just have effective teams. We're really, really good at what we do. But the overall market was definitely, especially the back half of the year, even when interest rates started ticking down, it was a real wait and see, and it's a function of all of these things that we've covered. It's the interest rates and the inflation and all these things, and now it's the notion of tariffs, and all these things did create a lot of wait and see for some sellers. And while buyers were trying to pursue deals, there were fewer deals to attack, right? So you have a bunch of buyers chasing the highest quality objects, and those ones did trade, and they trade for outsized multiples. They traded for big numbers. And again, when you talk to as many buyers as we talk to, Derek, every day, and you hear that they did one deal, one platform last year, and 4 add-ons when their mandate was to do 3 or 4 a year, and 10 or 12 add-ons, you start to realize that these guys are raring to go. They really are anxious to put capital to work. So I think there's no doubt that that's the biggest factor that's going to drive M&A is the fact that there's $3-4 trillion of dry powder in private equity, and meaningfully more than that in corporate cash. And frankly, private credit last year meaningfully outsized senior debt in terms of deals. So you have all this senior debt with rates coming down. Lenders are going to open up and get looser with doing deals. They're going to lend more money. Private credit is not going to let that go without a fight. So they're going to drop their rates too. They're going to attack as well. So there's going to be a lot of debt cash out there to do deals as well, which we haven't really touched much on. So all this sets up for, I think, top to bottom, a really robust year.
Yeah. I mean, thank you. I think we covered a lot of ground here today on those, topics. So I think it makes sense to kind of move into the Q&A session. We received, a few questions throughout the webinar. So we discussed a lot of these topics today, but, just to address this question here, which we touched on before, but I think just to give a little bit more on it is, the question that came in is, I run a family-owned small manufacturing business and was considering selling in 2024, but decided to delay due to potential policy change, which we've heard throughout the webinar. With there still being uncertainty around tariffs and the cost of materials potentially rising, should I still delay selling until we know a path forward?
Yeah, it's a great question. And again, we cover a lot of ground in these webinars, and folks want to sort of look through their own personal lens and understand okay, that was a lot. How do I look at my own business? So let's dissect there. If you're a U.S. manufacturer, manufacturing is coming back to the United States. I don't think that's bluster. Again, because if you look at China, again, is our biggest import partner. Our biggest trade partner is Canada, then Mexico, then China. But in terms of imports, it's China. But China has a huge hole in their demographic base. The under 50-year-old crowd who does all of the work, they don't exist. So manufacturing was coming to other areas anyway. And with a focus in terms of our presidency on domestic manufacturing, there's going to be a lot of money flowing into it. A lot of money flowing into domestic manufacturing. So if I were a manufacturer in the United States, I'd be getting my business ready to sell. Because I think we're going to see a ton of capital going after these niche manufacturers, general manufacturers, even contract manufacturers. I think we'll see a huge uptick over the next several years in manufacturing in the United States. And if you're a manufacturer considering selling, man, you're in a really good spot.
Mm-hmm. And, another question that came through that's a little bit similar that we can bounce off with this one, will buyers discount my business if I have higher material or labor costs because of recent inflation?
Will they discount it because you have a higher, that's a tough question to answer, excuse me, strictly on its surface, because it really has to do with, higher compared to what? If it's higher than everybody else in your industry, the first question I'd ask is why? What are you doing? How are you running your business that it's higher than everybody else in your industry? If you're in an industry that has higher manufacturing costs or labor costs because of what you do and the expertise and the skill level that you need from your workforce, that's very different. So just because your margins may not be as good as somebody else's in a different industry doesn't mean you're going to get quote unquote paid less. I think that it's really about kind of from an industry level and from your peer set. If everybody in your peer set and the industry is running at a 20% EBITDA margin and you're running at a 22 or 18%, I think that's it's not going to matter as much in terms of like a big discount on the multiple. I think what we would do is really work with you to question and say, let's really look at the business. Let's look at the adjustments. Are you doing some things that can be adjusted that a buyer would do in order to say, oh, if you're at 18, no, actually, if you look at this on where they are from a normalized level, it's really more at the 21.5% or something like that. So I don't think it's as strict. I don't think that there's a penalty for that. I think it's relative to a peer set.
No, I think that's exactly right, frankly. So we're comparing not against the overall, hey, that's your cost of employment is really, really high generally. You're going to compare it against like companies. But even if you are paying your employees more, and we've seen this, but you have meaningfully better stability, you're not constantly recruiting, your turnover is really, really low. We've actually positioned that as an incredible positive. And buyers tend to, that resonates with most buyers because if you're spending your time recruiting, you lose consistency. It's hard to deliver service, especially for a service business. So it really depends on the why behind it, which is always the right answer, right? What's driving it? But we've seen it where, again, a 20% margin business is getting 17, and for really good reasons, because they have this incredibly stable, loyal, employment base. And as a buyer, you look at it and you say, well, this is predictable. You're not going to see these stochastic variations because of, all of a sudden I've lost 6 employees and now I'm putting my recruiting hat on and I'm not executing, I'm not managing, I'm not leading. So it really depends on the why behind it. And I totally agree with what Derek said. It's really, you're measuring yourself against a subset, in your industry, in your addressable market, really, not just the overall industry, but so that's how you're comparing.
Mm-hmm.
Yeah, and I think if I could just jump on, it goes back to the other point. I think the why behind it is a good one because it goes back to, even if your labor costs have risen over the last year or so, I think the stability is a great point because if you can show a tenure of your employees at an average that's much higher than your competitor base, even if you're at a lower margin, your valuation will actually increase comparatively. I think that's an excellent point. I think, but it goes to finding that why. It goes back to the question about how do I prepare my business for sale, is understanding those whys and being able to talk about them both positively and negatively, even if it's a negative impact. So that goes to understanding the drivers of your business and being able to explain it. But I think that the tenure and the stability of that is a great point.
Yeah, and I think, buyers might be able to see that also as an opportunity. If they see higher costs somewhere, but they're like, hey, I could easily fix that as soon as I acquire this, they might see that as an opportunity. And, to the seller, they're concerned about it, but as a buyer, that's a great opportunity for them. So another question that came in is, with the concerns of reduced federal spending in the future, are government-focused businesses less attractive to buyers in times of political uncertainty?
I'll start with this one. I think our sellers with government-funded business, again, I hate to do the old, it depends. I would say, no, I don't think they are in general, to give an answer. I think trying to, again, it goes back to it depends on the situation. If you're trying to forecast and future tell based on what a massive government program spending is, I think it's a fruitless effort. I think there's no point in doing that because it takes so long, things get blocked, things get delayed, things get changed. There's so many iterations of that. What I will say and what I advise our clients to do is in discussions with them, I had a client in a government segment, but a very specialized kind of training segment, is saying, well, if you know something very specific to your industry, and in this case, they did. It was at the beginning of last year, and they knew that some program was delayed and not going to happen until the end of the second quarter. That's very different in terms of let me kind of make sure that I get this contract, which I know they are spending and has been delayed for this specific thing in my specific industry for my company. That's very different from saying, the government said they're going to spend on infrastructure in 2025. Okay, so I would say from a governmental spending, it needs to be detailed as much as it can for your specific business in your specific industry. If there's things around that you know are either accelerated or delayed, then that's important. I think trying to tell the future about an overall government mandate on a broad category of spending is kind of pointless. That's my view.
Yeah, I agree. I think it's the classic MBA answer. It depends, as you said earlier. I mean, I think if you're a business that relies on sort of overflow, like you're not a core contractor, right? But you kind of do the work that you're the sub for a prime that does the same thing, but they can't perform it all, and you do overflow, and we've seen that. You might have some risk, right? We don't have a lot of businesses like that we're seeing, but there are some businesses that could, that operate off of government inefficiency, and they exist, right? They're not core. I could see them struggling to find a home.
Yeah.
But most of our clients aren't those. I mean, most businesses out there that are attacking the government in some way, like attached to it, either a flow in or out, are performing a service that is important, right? And those businesses should continue to thrive, I think.
Yeah, and unless there's some sort of, if your business is really dependent upon set-aside work, that you're tied to a specific government program where they set aside, work for your business based on a qualification, and things that are going to be delayed or accelerated based on that's very different from, just a general having, doing some government work, so.
Right, yeah. Well, thank you, Dara. Thank you, Derek. We covered a lot of topics in depth today. So I don't know if you guys just want to have a quick final thought on the M&A market to conclude this.
Yeah, sure. I'll start if you don't mind. I think, again, I've said this over and over. I do think 25 is going to be a really good year for M&A and for the economy generally. I do think large companies will focus a bit on sort of their core and look to make investment in and around the core versus have all these unrelated businesses. I think you'll see a lot of you'll break up some big companies. I think we'll see some acquisitions, of $50 billion companies. I think we'll take private. I think we'll see a couple of those this year. There's gonna be a lot of money moving this year, and I think there'll be a lot of non-tech companies buying technology companies. And we actually had an example of that I should have brought up earlier, where we had a semantic AI business that we had a buyer who owned a lot of oil wells in Texas, and he was going to use the semantic AI to identify dead oil wells and see if they could still produce. And that's just a way of taking technology and levering really old world businesses and industries. And I think you'll see a lot more of that. It's happened over the last couple of years. You'll see a ton of it this year. So it should be an exciting year.
Yeah, I do think, just echoing that, I think it's going to be a very exciting year. I think, like I said earlier, I think it's going to be a combination of a buyer's and a seller's market. I think it's just going to be a strong market where you're going to see a lot of quality deals, specifically talking from our client's perspective on the sell side. I think they're going to see a lot of solid offers. I think the structurals will be a little bit more favorable towards the sellers this year, just given all the cash. And so I think it's a great time to be on market. But again, it goes back to, get your company on market, see what is out there, see the valuation you get, see the structure you get, see the type of buyers you get, and then decide if it's right for you. Because you can't sell your company until you're on market, but you don't have to sell just because you're on market. So I think this year is going to present a lot of great opportunities on both sides. And then just speaking from our client standpoint, I think it's going to present a great opportunity from a deal structure and a deal valuation standpoint.
Well, thank you both. Like I said, we covered a lot. So if you guys have any follow-up questions or are interested in pursuing a potential sale, please reach out to us. Don't hesitate. We look forward to hearing from you. And thank you, everyone.
Thank you.
Thank you.